You know that phase when you're doing everything right, but trades still don't work. Entries are clean, logic makes sense, but the market just doesn't follow through. These are phases in the market where nothing works. Not your setup, not your experience, nothing. And if you don't recognize those phases, you'll keep trading and slowly bleed. Because in trading, it's not just about what you trade, it's about when you trade. The same setup, the same strategy can give you profits one day and completely fail the next day. Not because your setup was bad, but because the market conditions has changed. And if you don't understand that, you'll keep taking trades in an environment where no strategy is supposed to work. In this video, I'll cover 6 market conditions you should completely avoid because they kill consistency and create unnecessary losses and mental pressure. And more importantly, you will understand why staying away during these market conditions is more powerful than finding a perfect setup in a chaotic market. Because sometimes the best trade is no trade at all. Sideways market is the first condition, and I'm starting with this because everyone already knows it. I still want you to stay till the end of this video because the next 5 conditions are far more dangerous than just sideways. Sideways is comparatively very easy to spot, at least for me. You can clearly see price moving in a range, but all the other conditions that are going to come after sideways, they are much harder to spot, and that's where I believe most traders lose money. Because everything looks tradable, your technicals also align, your setups look clean, but the trade still fails. Now coming back to sideways, a sideways market is simply when price finds a fair value. Buyers and sellers are in agreement, there is no urgency, there is no imbalance, and when both sides agree, there is no reason for price to move. And without movement, there is no trade or edge. Why is it dangerous? Because most traders try to force logic here. They see breakouts, they see reversals, but nothing sustains. Because the market is not ready to move yet. And the key limitation with a sideways market is that you cannot predict when it will start and when it is going to end. The only rule with a sideways market is when you see sideways market, don't trade. If the market is not moving with intent, you shouldn't be trading with intent. Here are some examples of sideways market. In this example, you can see that there was a breakdown to the downside, and then a breakout to the upside, and then again a breakdown. All 3 failed. And this is what exactly sideways market does to you. Expansion is the second condition that you should avoid trading. In expansion, what happens is that the market keeps changing the major direction aggressively. In a normal trend, you expect structure, higher highs after higher lows or lower lows after lower highs. But in expansion, a higher high is followed by a lower low, then again a higher high, then again a lower low. The market keeps flipping direction. There is no consistency in structure. Now, why is it a problem? The biggest issue here is your bias keeps getting invalidated. You think it's an uptrend, it breaks down. You think it's a downtrend, it reverses up. Pullback strategies completely fail here because you are waiting for continuation, but market is not continuing anything. With each move, volatility increases, moves get bigger and faster and more violent, which means more traps, faster stop outs, less control over your trades. At some point, it even becomes impossible to take a clean directional trade. Now, if you find yourself in expansions, the first thing that you should remind yourself is there is no need to trade this. Second, if you must trade this, don't use directional strategies. Don't stick with one direction. No trend trades, no pullback trades, because there is no stable direction to trade. And most importantly, let the market settle. Let one side take control, because expansion is not where you make money, it's where you avoid losing it. Now here are some examples of expansion and how it looks on the real chart. As you can see, a lower low followed by a higher high, then again a lower low, then again a higher high, then again a lower low, then again a higher high. This can keep on going. There is no limitation to this, how many legs it is going to form. The minimum that you need to call it a expanding pivot is 3, but it is not limited to 3 or 5 or 7. It can go as many times as it wants. Here is another example. Another one. The third bad condition that you should avoid trading is contraction, and it is also the one that I personally hate the most. Contraction is when the market starts compressing into a tighter and tighter range. Highs keep getting lower and lows keep getting higher. Price is getting squeezed into one point. Each move becomes smaller than the previous one, and the distance between swings reduces and momentum keeps fading away. What's actually happening behind this pattern is both buyers and sellers are losing strength at the same time. Unlike expansion, no one is able to take control. This is not a trend, and this is certainly not a reversal either. It's just a pause before a move. Now, why is it a problem? The first thing is there is no meaningful reward. Even if your trade works, the move is just too small to justify the risk. Second, it tricks you into anticipation, because as the range gets tighter, you feel like a breakout is coming. So instead of waiting, you start guessing the direction. Third reason is trap becomes more aggressive. The slower the market moves, the sharper the fake move becomes. So you'll often see small breakouts, sudden spikes, and quick reversals. And because the range is tight, even a small spike can hit your stop loss. And the fourth reason, and why I hate this pattern the most, is it drains you mentally. Nothing is happening, but you're still watching, still analyzing, still trying to find something that often leads to forced trades. Now, what you should do in this situation: don't trade inside the contraction. There is no edge inside compression. Wait for a breakout, let the market expand first, then look for opportunity. And you don't need to catch the breakout also. You just need to catch what comes after it. Let a trend settle first. Because contraction is not where money is made, it's where energy is being built. And only when that energy is released does the real opportunity begins. Here are some examples of how contraction looks on the real chart. So you'll see highs keep getting lower, lows keep getting higher. This is a very common pattern. This condition has two opposite sides, but both leads to the same outcome, and that is no clean opportunity to trade. The first one is called no breaks. Have you ever seen this? Price just keeps going, candle after candle in one direction. There is no pullback, no pause, no structure. You keep waiting for that retracement, but it never comes. You tell yourself, little pullback, then I'll enter. But it keeps moving. That's a no breaks market. There is no higher lows forming, no lower highs forming, just a straight move. It looks strong, but it gives you nothing to work with. Now, why is this a problem? The first thing is you don't get entries. The second reason is you feel like you're missing out, and eventually you start chasing, which usually means you enter right before the move slows down. What you should do in this situation is accept it that you have missed it. Wait for structures to form again, because the clean moves doesn't always means tradable moves. Now here's how it looks on the real chart. You will see very small pullbacks or no pullbacks at all, and the move will just go. The second part of this condition is too many breaks. The second part of this condition is too many breaks. It is where you feel like something is happening but you cannot read it clearly. Price keeps breaking small highs, then small lows, then again small highs over and over again. You see setups everywhere. Every small move looks like an opportunity, but nothing feels clean. Nothing feels reliable. That's a too many breaks market. Structure is there, but it is fragmented. Instead of one clean flow, you get multiple tiny flows inside each other. Now, why is this a problem? The first reason is you lose clarity. The second reason is you keep changing your bias because the price is moving in all of the directions. The third reason is even if you're right, noise will stop you out. What you should do in this situation is step back, ignore the small movements, wait for a dominant structure to appear because your edge is not in reacting to everything, it is knowing what to ignore. See, a good market doesn't just move, it moves in a way that is clear enough to trade. This is how it looks in the real charts. The fifth condition is small candles. Sometimes the market doesn't stop, but it doesn't move also. Price keeps printing candles, but each one is small. Bodies are weak, closes lack conviction. There's movement, but no real intent behind it. Candle starts overlapping, wicks mix into each other. Everything feels compressed. This is not a clean sideways range. This is a low energy price action inside movement. The market is active, but participation is weak. Now, why is this a problem? The first reason is there is no conviction. Neither buyers nor sellers are strong enough to push price. So, even when price moves, it doesn't follow through. The second reason is your setups lose reliability. Breakouts don't expand, reversals don't sustain. Everything starts to feel random at this point. Third reason is it creates deceptive structures. Levels still react, patterns still form, but without energy, they don't behave the way they should. So you take trades that look correct but don't perform. The fourth reason is it slowly drains your edge, not through big losses, but through inactivity. You enter, wait, nothing happens, you exit early or get chopped out, and over time that adds up. What you should do in this situation is don't trade low energy markets. Wait for expansion in candle size. You want to see strong candles, clean directional closes, separation between candles. That's when participation returns. One practical rule here is at any key level, observe the last 10 to 15 candles. If they are noticeably smaller than the normal behavior of the market, avoid, because this is not just low volatility, this is low opportunity. If the candles have no strength, your trades won't either. Here are some examples of how it looks in the real chart. Very small candles. The sixth condition is not one single condition. This is when multiple bad conditions start overlapping. Sideways behavior, expansion, contraction, messy structures, unstable candles. Not always at the exact same moment, but in a sequence so tight that the market never stabilizes. One phase starts before the previous one completes. You see a clean move, it turns into expansion. Expansion slows, it compresses into contraction. Contraction breaks but fails and goes sideways. And before you can adapt, it changes again. There is no continuity, no consistency, no rhythm. Now, why is this a problem? At this point, the problem is not the market. The problem becomes you trying to keep up with it. Because technically, everything still looks tradable. You can always find a level, a structure, a setup, a reason to trade, but none of it has real edge. First is your analysis keeps resetting. Every time you build a view, it becomes irrelevant. Second is you start overtrading because there is something always happening and your brain doesn't like inactivity. Third reason is you lose clarity slowly, not in one big mistake, but in small decisions. Maybe this will work, let me try this, one more trade, and this keeps on going. And before you realize, you're no longer trading a system, you're just reacting. And the fourth reason is this is where most damage happens, not because of one bad trade, but because of series of low quality trades. Now, what you should do about it? The first thing is recognize the shift. When the market stops making sense, this is the signal. Second is stop trying to solve it. This is not a puzzle to figure out. Step back, let the market stabilize, let one condition take over clearly. You don't need to catch everything, you just need to catch what is clear and repeatable. Because when everything is happening, nothing is tradable. When the market loses structure, you don't adapt to it, you step away from it. Now, here are some examples of how it looks like on a real chart. As you can see in this example, the first thing is it is in a sideways motion overall. You also spot a lot of small candles. You spot expansion followed by a contraction and too many breaks. So these are 5 conditions in one market scenario. Here is another example: expansion followed by a contraction, very small candles, and too many breaks. Another example. What you must understand is 95% of the time the market is in bad conditions, and that's exactly where your setups starts losing reliability. You take a trade, it looks clean, it follows your rules, but it doesn't work. And the first thought is maybe something is wrong with my strategy. But most of the time, the problem is not the strategy, it's the environment you're applying it in. You're trying to use a structured approach in an unstructured market. And this is where things starts to go wrong, not technically, but psychologically. FOMO. You see movement and you feel like you have to be in it, even when there is no real setup. Action bias. You feel the need to do something. Sitting out feels wrong. So you force trades. Third, overconfidence after a few wins. You assume your system works everywhere, so you stop filtering out conditions. Fourth, strategy hopping. When trades fail, you start tweaking, adding, changing things that were not the problem. Fifth, recency bias. The last few losses feel bigger than they are, so you abandon a system that actually works in the right condition. The shift you need is the edge is not just in your setup, it is when you choose to use it. If you remove bad conditions, you don't need a better strategy, you just need better selection. Because if 95% of the market is just noise, that means only 5% of the times the market is actually clean, structured, directional, and predictable. And that's where your setup works. In the next video, I'll break down 5% of that market where everything aligns and trading actually makes sense. Because the goal is not to trade more, it's to trade when it matters.